Welcome back. Today is 2026-07-21. Our AI system scanned 132 stocks and identified the 5 most important names to watch today. Let's get into it. Oracle is down 64% from its 52-week high, trading near support and deeply oversold on technicals. But here's the puzzle. The options market is flashing bullish. For every dollar betting on Oracle falling, $2 are betting it rises. Put-to-call ratio 0.694. That means bullish options positioning, indicating smart money is not panicking despite the price collapse. That divergence between the beaten down price and optimistic options crowd doesn't happen by accident. Either the price bounces fast, or those call buyers are about to face reality. Our system flagged a setup worth watching, but conviction is LOW. No clear catalyst visible yet, so timing is critical. Oracle lost 2.81% today on volume that's only 64% of average. Light selling, not capitulation. Weak volume on down days historically tends not to stick. The real story. Oracle has cratered 64% from recent highs, and now trades $66 below its 50-day moving average $176.69, and $67 below its 200-day $189.42. MA $50 $176.69. That's the intermediate trend line. Oracle has broken decisively below it, signaling regime change. That's a deep technical disconnect. The chart shows support at $120.03. If that level holds, the next resistance test is $183.94, a 50% recovery from here. If support breaks, downside opens to $109.98, the stop loss. Volume confirmation matters now. A bounce needs above average volume to be credible. RSI 27.83, that's oversold territory below 30, meaning the stock has been sold so aggressively that a bounce is statistically more likely from here. Historically, oversold stocks RSI below 30 bounce 70% of the time within 5-10 sessions. But here's the caveat. Oversold doesn't mean it can't go lower if fundamentals deteriorate. Volume 0.64 times average tells you this wasn't panic liquidation. It's slow, grinding selling, which is actually fragile and prone to reversal on any positive catalyst. The moving averages paint a picture of damage. Oracle traded above both 50-day and 200-day just months ago. Now it's trading 54-67 points below them. That separation signals the uptrend is broken. Technical tension. Oversold reading screams bounce, but fallen moving averages warn the regime is down. Our system sees the bounce setup, but flags at low conviction until we get volume or news confirmation. Top news is data unavailable, earnings date is unknown, and that's the real vulnerability. Oracle doesn't crater 64% in a vacuum. There's always a catalyst behind that kind of move. Earnings miss, guidance cut, macro shift, sector rotation, or competitive threat. Without visibility into what triggered the collapse, we're betting on a reversal based purely on technicals. That's weaker than earnings beat coming or new contract announced. Downside scenario. If Oracle reports earnings and misses, the $120.03 support could break hard. Upside scenario. If the company announces a major contract, accelerates buybacks, or guides higher next quarter, $183.94 resistance becomes reachable fast. The absence of a clear catalyst is why conviction is LOW. Technicals alone can work short term, but they're not foundation enough. We're watching for the news that confirms the bounce thesis. Put-to-call ratio 0.694. That means for every dollar bet on Oracle falling, $2 are betting it rises, which signals bullish options positioning from smart money. They're not panicking. They're accumulating calls. Implied volatility at 0.639463.94%. That's elevated, indicating the options market expects meaningful price swings in either direction. When Roman 4 is elevated and put-to-call skews bullish, it means the market prices in a big move with more conviction on upside. The trade setup is clear. Entry zone $120.03, $122.92 with targets to $140 14% move or $164.57 34% move gives positive risk reward of 1.32. The options crowd's positioning says this bounce is worth watching. Caveat. Elevated Roman 4 means both calls and puts are expensive, so selling near targets becomes more viable to lock in gains. Our systems read on Oracle. Watch, down bias, LOW confidence. The setup favors a bounce, targets imply upside, but the system isn't shouting certainty. Here's the reasoning. Oracle is oversold on technicals RSI 27.83, positioned bullishly in options P/C 0.694 and testing support, all bounce signals, but it's also 64% below highs with no visible catalyst and light volume selling. The tension between technical setup and fundamental vacuum is why conviction stays low. If ORCL holds $120.03 support and closes above $125 on volume 1 times average, the bounce thesis gains traction and entry becomes safer. If support breaks $120.03, the stop loss at $109.98 is the line in the sand. This is a watch list candidate, too early to commit capital, but positioned well enough to monitor closely. Conviction will rise once either support confirms or catalyst clarity arrives. ORCL's setup is a classic oversold reversal candidate trapped between technical signals screaming bounce and market conditions demanding patience. The system flagged it as watch because the risk-reward is there but conviction is low. Next 24-48 hours matter. If ORCL holds $120.03 and closes above $125 on above average volume, the bounce is confirmed and entry becomes tactically sound. If $120.03 breaks, the stop at $109.98 is your exit. For viewers tracking ORCL, patience pays here. Don't force the trade. Let support either confirm or fail. Both outcomes give clear signals. Our system will update the verdict as soon as either catalyst clarity emerges or price action progresses. Until then, watch, monitor volume, wait for confirmation. This is the kind of setup that rewards discipline. Tesla is down 1.41% today on weak volume, 35% of average, and sits 24.7% below its 52-week high. As the broader big tech sector faces earnings season reality checks, Tesla's setup is flashing a specific warning. Momentum has rolled over, but the stock hasn't broken below key support yet. This is a pivotal moment. The earnings landscape is testing whether mega-cap growth narratives can survive tighter valuations. Tesla's valuation, revenue growth trajectory, and macro exposure to AI hype all hang in the balance. Our system's read is watch, not yet decisive, but the directional bias is clearly lower. Let's decode what's happening under the surface. The 1.41% decline on 35% of normal volume tells a subtle but critical story. Sellers aren't rushing to the exits, but buyers aren't rushing in either. Weak volume down days often precede capitulation, sharp sell-offs on panic volume or relief rallies on accumulation. Tesla's quiet slide suggests the market is waiting for earnings, waiting for macro clarity, waiting for proof that growth can justify valuations. The stock has drifted lower without conviction selling, which means the downside move is fragile. One catalyst could reverse it. One catalyst could accelerate it. The lack of urgency in today's volume suggests money is currently on the sidelines, which in a downtrending market is bearish by default. RSI at 41.03, that's neutral, right at the midpoint, which means Tesla has sold off enough to no longer be overbought, but not deeply into oversold territory, where mean reversion bounces typically ignite. Price sits at $375.45, below the 50-day moving average at $409.34. That's a bearish setup, suggesting recent higher lows have been broken, and also below the 200-day at $416.7, confirming the downtrend is established across multiple time horizons. The broader context: Tesla is 24.7% off its 52-week high, deep enough to scare many buyers but not yet at the capitulation extremes where contrarians pile in. Support sits at $368.6, less than $7 below today's close, while resistance looms at $432.86, nearly $60 away. The asymmetry here is stark. Downside is immediate, upside is distant. The immediate catalyst is big tech earnings season itself, a period when investor narratives about growth, profitability, and capital efficiency get reality tested. For Tesla specifically, the catalyst is earnings, but the timing and exact date are not in our current data set. What matters now is that Tesla's revenue growth trajectory, margin compression or expansion, and forward guidance on AI and autonomy will determine whether the stock rebounds from this 24.7% drawdown or slides further. The market is pricing in uncertainty. That's why volume is soft. Once earnings hit, volume will spike and the stock will likely make a decisive move, either a relief rally if numbers beat or guidance is optimistic, or a capitulation cascade if disappointment compounds existing macro doubts. Until that moment, Tesla sits in a holding pattern. The put-to-call ratio is 0.811. That means for every dollar bet on the stock falling, about $1.23 are betting it rises, which is bullish options positioning. Options traders are positioned more bullishly than bearishly, expecting upside breaks above current levels. This creates a potential mismatch with the price action trend. Tesla is downtrending on weak volume, but smart options money is hedging upside. That's a classic pre-announcement positioning pattern. Traders expect either a big gap up on earnings beat or see value at current levels. ATM implied volatility sits at 15.53%. The options market is pricing in moderate uncertainty, neither complacent nor panicked. When earnings drop, Roman 4 could spike if the move is large or deflate if results are priced in. The call-heavy positioning suggests the options market expects a snapback rally sooner rather than a deeper sell-off. Our systems read on TSLA. Watch, down bias, moderate confidence. The data flags that momentum has rolled but capitulation hasn't yet arrived. Tesla sits above support at $368.6, but below both moving averages, a setup that typically precedes either a decisive breakdown or a relief bounce. For traders watching entry, the system identifies an entry zone between $368.6 and $375.76, with a stop loss at $342.67. Targets are set at $400 T1, modest recovery, $416.22 T2, 50 DMA reclaim, and $460 T3. Major resistance reclaim. The risk-to-reward ratio is 0.73, meaning upside targets are less than 1x the downside risk. This unfavorable R:(R) reflects the current environment. Upside exists, but is constrained by earnings uncertainty and macro headwinds. The moderate confidence reflects incomplete data on the catalyst timing. Watch for three things. First, Tesla's earnings announcement and the date it lands. That's the catalyst that will break the current holding pattern. Second, if Tesla holds above $368.6 support, a relief bounce toward $400-416 becomes likely. If it breaks below, the next support level is much lower, and capitulation could accelerate. Third, monitor volume into earnings. Historically, volume expansion ahead of major announcement signals institutional positioning shifts. Until then, Tesla remains in a watch state. The verdict is down biased, but the data shows options traders expect upside, creating a potential divergence to monitor. Alibaba is bouncing today, up 5.69%, but the story underneath tells a different tale. A stock doesn't move on its own. Money moves it. When volume is light, that money is quiet. BABA bounce came on just 0.62 times its average daily volume, that is, for every 100 shares normally trading, only 62 moved today. Light volume on an up day means retail enthusiasm without institutional conviction. That's the setup we're watching. The real question is whether this bounce has legs, or whether the larger downtrend reasserts. Let's dig into what the data actually says. BABA is trading at 121.51, roughly 36.4% below its 52-week high, which means it has given up a third of its recent peak value. More importantly, price is above the 50-day MA at 117.47, but well below the 200-day at 142.71. That gap, price sandwiched between the 50D and 200D, signals a downtrend in progress. The bounce today sits within this larger structure. Resistance lands at 121.55, almost exactly where price is now. Support sits at 91.99. If BABA fails to clear 121.55 on heavy volume, expect a pullback toward the 50 DMA and lower. RSI is at 65.56, that is, approaching overbought territory at 70, which means the stock has been bought aggressively in the short term, but hasn't yet reached the threshold where a pullback becomes statistically likely. Still room to run higher before momentum exhausts. The reason we're watching RSI is that BABA bounce came on light volume. If RSI reaches 70 plus on heavier volume, that would suggest real institutional conviction. Right now it looks like a local bounce, not a trend reversal. Momentum is extended but not yet extreme, still distinguishable. Here's the gap in the thesis. We don't have a clear catalyst. The data available doesn't include the fundamental reason why BABA is moving today, and earnings information is not available. That's a material red flag. This bounce has no known anchor. It could be algorithmic, options related, or macro momentum. When a stock moves without a clear catalyst, the move is more vulnerable to reversal. BABA is on a stocks to watch list, which suggests retail attention, but attention alone doesn't drive lasting moves. We're watching for confirmation this bounce is real, not just a head fake to trap buyers. Put to call ratio is 0.438. That means for every dollar bet on the stock falling, $2.28 are bet on it rising, which is very bullish options positioning. Calls are being bought more aggressively than puts. However, implied volatility is at the 50.29 th percentile. That is, options on BABA are priced near the middle of their historical range, which means buying calls right now is not getting you a volatility discount. You're paying fair value for upside exposure, not a cheap one. This matters because when taking directional risk, ideally you want to pay as little as possible. Mid-range Roman 4 suggests the options market is balanced, neither panicked nor complacent. Our systems read on BABA. Watch. Neutral bias. Moderate confidence. This is not an entry signal at current price levels. The entry zone is 110.00 to 113.30, a pullback of approximately 79% from today's price. The system is saying, if BABA breaks above resistance at 121.55 on heavy volume, that changes the picture. Otherwise, a pullback into the 110-113 zone is more attractive from a risk perspective. Stop loss is placed at 103.68. The risk-to-reward ratio at 0.01 reflects entry at today's price. It's essentially flat, reinforcing that entering now is suboptimal. The system favors waiting for either a pullback to the entry zone or volume confirmation of further upside. BABA is telling two stories right now. The short-term story is a bounce on light volume, not enough conviction to call it a reversal. The medium-term story is a stock 36% off highs, below its 200-day MA, and without a clear fundamental catalyst. Our system is neutral because the bounce lacks institutional conviction. Watch for volume to pick up if BABA is going to hold gains. If volume stays light and the stock fades back to 110-113, that's where the next entry opportunity appears. For now, this is a watch, not a buy. Today's look at Roblox RBLX comes as the gaming landscape shifts. Headlines now compare it directly to Take-Two Interactive. The stock is up 6.81% today, a move worth examining, because it's happening on unusually light volume, just 0.33 times the daily average. Our system's read is that this upside lacks conviction. Trading RBLX right now means answering a fundamental question. Is this a genuine shift in the company's competitive positioning, or temporary momentum in a stock that's still 63.4% below its 52-week high? That news angle, the Take-Two comparison, is what's driving screen watchers to look at RBLX today. We'll break down what the data actually says beneath the headlines. Roblox is trading at $55.2, and while a 6.81% one-day move catches attention, the context matters. That move is happening on volume that's nearly 70% below average, which tells us the rally isn't backed by institutional money flowing in. Looking at the bigger picture, RBLX has fallen 63.4% from its 52-week high and is still 24.9% below its 200-day moving average $73.49. The 50-day moving average $48.21 is recovering, but it's a weak anchor when the 200-day sits so far above. This is a stock in a downtrend trying to bounce, not a stock breaking out a new conviction. Our systems modules combine RSI, put/call ratios, and implied volatility to score conviction. RSI is at 55.49. That is neutral territory, meaning the stock hasn't been bought aggressively enough to be overbought, nor sold off enough to be oversold. That usually signals sideways indecision. The put/call ratio tells a different story, 0.456. That means for every dollar bet on the stock falling, there are $2.19 bet on it rising, which is very bullish sentiment from options traders. But here's the tension. The modules assigned LOW conviction to the watch verdict, which means these bullish signals aren't enough to flip the system toward confidence. The data is mixed, and mixed data is why conviction stays low. The headline driving today's move, the Take-Two comparison, is a narrative catalyst, not a fundamental one. That's a risk. If the market's comparing RBLX to Take-Two, it's weighing them as peers. RBLX would need to prove it can compete on profitability, user retention, and IP moat, areas where Take-Two has demonstrated strength over years. No earnings date is listed in our data, which means the next true catalyst is either a surprise earnings beat RBLX reports quarterly, or news about user growth, engagement hours, or monetization per user. Until then, the Take-Two narrative is a short-term headline that can reverse as quickly as it arrived. Sentiment-driven rallies lack staying power without follow-through on fundamentals. Put/call ratio at 0.456, meaning call buyers outnumber put buyers by more than 2 to 1. Signals that options traders are pricing in more upside scenarios than downside. Implied volatility at 0.644. That is elevated volatility territory. Options are more expensive than they were when RBLX was less contested. This matters for traders thinking about entry. Buying calls here means you're paying a premium for that perceived upside. Selling puts means you're receiving extra credit for taking downside risk. The question is whether that options positioning reflects real conviction or just short covering and momentum chasing ahead of the earnings cycle. Our system's answer: not enough conviction to call it high confidence smart money in accumulation. Our system's read on RBLX: watch, neutral bias, LOW confidence. This verdict means the data doesn't point sharply in either direction. The stock is oversold from its 200-day high, but that downtrend is still in force. Options traders are bullish, but RSI is neutral. News is positive competitive comparison, but earnings are unconfirmed. Each signal alone might suggest a play, but together they're contradictory. Watch means keep it on the screen. Neutral means don't initiate a new position based on bias. LOW conviction means don't risk meaningful size on this setup. When the system can't find conviction, the trade simply isn't here yet. Here's what matters for risk management. The entry zone is extremely tight, $55.0 to $55.08, and the stop loss sits at $50.4, a 4.6% drop to stop out. The risk to reward ratio is 0.72, which is unfavorable. You're risking $1 to make $0.72 at the first target, $58.43. Volume being weak 0.33 times also raises the odds of slippage if the stop is hit. If this stock is going to deliver a high conviction trade, it'll likely need either a breakout above resistance $58.43 on volume, or a deeper retest of support $44.7 that sets up a capitulation bounce. Until one of those happens, this is a watching situation, not a buying situation. That's our top 5 for today, all generated by an automated analysis system. This is educational content, not financial advice, and not a recommendation to buy or sell anything. Always do your own research. Like, subscribe, and set the bell so you never miss a daily brief.